Business and finance. Very often I have heard of executives saying that finance division is driving the business, and I have also seen a CEO who was from a sales background, and he drove growth so hard that and he could not manage the cash side of it, and the organization ran out of cash. Why do these kind of things happen? Every person, every manager must understand that running a business organization has two sides of it. One is running the business, as in the business value chain, the products, the services, whatever you're delivering, and doing it in the most efficient and cost-effective manner, as well as adding significant value to customers and your segments. The other side of it is finance. Whenever a business is running, every business needs funds for two reasons. One is for its daily operations, which is known as working capital, and the other is for the growth and therefore the investments, growth and investments. Now, it should be clear that every business must generate sufficient returns so that both of these needs are as well funded from the business activities itself. Now, very often you would see organizations saying that they have gone on an expansion spree, and for the expansion the funds required are internally generated, are from the internal accruals. Now, when they are saying something like that, what it says is that they are going to invest and grow, but they do not need to borrow. No need to borrow. Now, is it a good thing? Of course. One has to see, because whenever we are talking of borrowing funds, there is normally an interest, and interest is a tax deductible expense. So therefore there is some analysis to be done, and that's where the finance side comes in. So while the business will say that we need to grow and they can have the market clear, the finance side should come in to aid the process. So what are some of these very important aspects of business and finance that every manager must know? Let me break it up into two things altogether. One of them, I call it as growth-related metrics, and the other, I call it as profit-related metrics. Now, profit-related means you will use the word returns, and growth-related means you will use the word turnover. So yes, the turnover of an organization must increase. So what is the total sales divided by assets? This gives you asset turnover. How many times have your assets, using the kind of money that has been invested in your assets, what is the kind of returns that you have, what is the kind of sales that you have been able to generate? How much have you been able to sweat out your assets? Now, there might be other growth-related metrics like inventory turnovers, which is equal to, how do you find this out? You'll find this by looking at COGS by inventory, and there is a complete module dedicated to this. While this side of the business is one side, and how do you find out the various numbers? Sales you'll find out from profit and loss, and assets you'll find out from the balance sheet. So similarly, like this, a lot of data is actually available for a business to run it profitably, to grow it. Now, counterbalancing the growth is the profit metrics. Now, profit metrics means that how much returns are you giving to the organization. Now, typically, how much returns should an organization earn? One must earn beyond, an organization in function must earn beyond cost of capital plus inflation. Now, understand that cost of capital and inflation both are towards the cost side of the business. So these go a long way in increasing the cost of the business. So typically, if your cost of capital is 12% per annum, as in India it is, and your inflation is close to 10% an annum, you will have to earn a return of at least 16% on sales. Yeah, so that when you are converting your goods from in the value chain, you add adequate amount of value to it so that you can justify these kind of returns. Of course, there's a weighted average calculation which one can do for this, but at least you must have 16% from on sales from cost. So therefore, when you are looking at profitability metrics, you will look at things like profits by revenues. Okay, what is your profitability? Okay, so is it worth this or not? You would look at how much of cash you cash in hand. You would look at the working capital need. Now, it's very critical to understand that these two metrics need to be balanced, because growth is as good as it is profitable. If it is a not profitable growth, it's no point growing the business because you are making more and more losses. Understand that the world of business and the world of finance are very, very strongly interconnected, and a good business manager must be able to know precisely what is his business value chain. In his business value chain, where is the transformation, how is the transformation happening of the goods, and when the transformation of goods is happening, how is the value being added, as in which place, in which part of the transformation is the maximum value being added. What I mean is that the cost translating into price, in which part maximum of this is happening, and these go a long way in building an effective business which is sustainable over time. Challenge being that this is a dynamic environment. Every aspect of finance will change, every aspect of business will change, your competitors will change. You know, in the business there's a business model, there are competitors, there is regulatory, there are very many aspects. And in the financial side, you'll have the cost of capital, you'll have the returns side of the story, how much are you really generating, various aspects. Now, all of this in a very comprehensive way, a business manager should understand very well, so that he can lead his business towards a positive direction. If you are unable to get this handle right, somewhere or the other, you will either not be able to grow your business, or you will not be able to generate profitability. And these two are like two scales, they have to go hand in hand, balanced.